A few years ago, money was nearly free, and companies borrowed all they could. That debt did not disappear. It is simply coming due. And when it does, it has to be paid back or borrowed again at today's far higher rates. For a lot of mid-sized companies, especially in tech, that quiet handoff is the real risk of this whole cycle. So here is the question, worth a few minutes. How exactly did cheap money turn into a trap? And who is standing closest to it? Start with the setup. In 2020 and 2021, interest rates were pinned near zero. Borrowing was almost free, so companies loaded up, and many did it with short-term or floating rate debt. Because why lock in for long when money is this cheap? For a fast-growing, not yet profitable tech company, cheap debt was rocket fuel. It funded growth that the business itself was not yet paying for. As long as rates stayed low and new money stayed easy, the math worked. Then the reset. Starting in 2022, rates rose at the fastest pace in decades. For a company with floating rate debt, the interest bill climbed in real time. For one with short-term debt, the day of reckoning is the day it matures. Because to keep the money, it has to refinance at the new, much higher rate. The same loan that cost almost nothing now costs a great deal. Nothing about the company changed overnight. The price of its money did. This is the maturity wall. A stack of debt issued in the cheap years, all coming due in a window, and it has to be rolled over into a world of high rates. A company facing the wall has 3 doors, none of them comfortable. Refinance and watch interest eat the profits. Dilute by selling new shares cheaply to raise cash. Or sell assets or the whole company from a position of weakness. The wall does not care about the story. It only asks one question. Can you pay or can you borrow again? So who stands closest to the wall? Watch one number above all. Interest coverage. How many times a company's operating profit covers its interest bill? When that ratio falls toward 1, almost every dollar of profit is going just to service debt. The most exposed are mid-sized cash-burning companies, often the not yet profitable tech names, that leaned hardest on cheap debt and have the least cushion now. The giants can refinance easily. It is the middle that gets squeezed in silence. So, what is the honest test? Again, not a prediction, a checklist. Watch interest coverage and whether it is falling. Watch the maturity schedule, how much debt comes due and when. And watch the mix of fixed versus floating, which tells you how exposed a company already is to today's rates. None of this is a forecast and none of it is advice. It is a framework, a way to see a trap that was built quietly in the years when money was free and to know which dials reveal it.